Hi YouTube, how are you today? Hope you're doing well. It's Sunday, May the 24th, 2020, and I just wanted to say one thing before starting the video. I just want to give a huge thank you to anybody who's been watching my videos, to my subscribers. So it's been 4 months since I started this channel and we've gone from 0 to 1,000 subscribers, and I'm thrilled at how this happened. So it's really interesting. And I just want to say thank you so much. If you enjoyed the videos, that means a lot. And I'll continue to upload videos as long as the flow is there for me. And yeah, so one day at a time, one video a day, and let's just keep it going. That's pretty much it. All right, guys, so today I want to talk about a few things. One of them is going to be talking about trading sample sizes and basically learning how to develop your process to the point where you're measuring your edge in terms of sample sizes of trades. So you're not thinking about trading from one trade at a time. This is a mistake that a lot of newer traders make, where they come into it and they're always looking for a trade and they want the most confirmation possible before entering the trade, and they're always excited about a certain trade, and they think that they're looking for that master trade that's gonna make them $1 million in one shot, you know? And that's a big mistake, unfortunately, is that you're not gonna find these master trades all the time. Like sometimes you might get lucky and get a huge trade, you might make like 100% or 200% on a trade or something, but the reality of the matter is that those things don't happen all the time. And again, it's relative to your trading style, but for me, I'm a short-term trader, so I'm looking to quantify a short-term edge and trade it over a large amount of occurrences to measure an edge, essentially. So it's the same mentality as the casino, essentially. The casino is able to quantify their edge in every single game that they have. And they're not walking around all day saying, okay, I just lost 10 grand, I just lost 5 grand, and blah, 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 because they know over time where their edge is, and they know that over time they're going to be profitable because their edge has a theoretical probability of profit to it because of how it's designed, right? So what we should be doing as traders is measuring our edge over a number of occurrences. I came across this idea first from the book Trading in the Zone by Mark Douglas. It's a very common idea, actually, and it's just measuring your probability of success over a number of occurrences. And basically there's two things you need to be concerned with. One of them is your win rate, so win to loss ratio, based on the trades you take. And number two is your percentage returns on those occurrences. I'm going to show you an example of a sample size that I created. So I journal all my trades, and I don't always journal the percentage returns on the trades, but I do keep an eye on my annual year-to-date return, which is still negative, by the way, but just a little. What I'm more concerned about is tallying up my trades and seeing where my edge is and how my edge is performing in the short term, because that gives you a better indicator of how your edge is performing in the current market environment, all right? I did a couple of tallies here. One of them was first 2 weeks of May. I had a tally that I tallied up approximately 29 separate trades, 19 of which were winners and 9 of them were losers. So you can see that that's a very good win rate, although I believe that the P&L was largely unchanged, if probably even negative. Again, because I'm still having problems with risk management, which is one of the more common problems for traders to go through. And that's why I'm trying to mechanicalize my process as much as possible so that to avoid having these kinds of losses. So again, when you're getting in there trading, your goal is to identify the trades and then manage your risk every single time. Our goal as traders is to manage risk before anything. So that was the first tally. I had 29 trades, 19 winners, 9 losers. And then the following week here, so starting from May 18th until May 22nd, I had a total of 17 trades. So this was the week that had just passed. And I had 10 winners and 7 losers. So still having a solid win rate, although the net profit was relatively flat, again, because allowing losers to become bigger than winners is a very common occurrence in trading. Okay, so I made a lot of common mistakes this week, and I'll be honest with you, I didn't actually have 7 losers, but I wrote a loss every single time that I made a common trading mistake. So if I made a mistake like averaging down a loser or not cutting a loser quick enough, I categorized that as a loss in my win to loss ratio. So I kind of skewed it a little bit to the loss side based on if I made trading mistakes or not, mechanical errors, I mean, okay? So things like averaging down losers or not cutting losers in time, I categorize that as a losing trade to begin with, even if it ended up being a winner in the long run, still consider a loss because I practiced bad behavior. Got it? So again, talking about sample sizes, if you're a newer trader, I want you to learn about this. I want you to think about trading an edge in a sample size. So if you're able to identify a trading setup, I want you to learn how to trade that setup every single time you see it, and then mark down your results afterwards and trade it every single time that it's present, so that way over a number of occurrences you can see how that edge is actually performing. So again, you want to keep an eye on your percentage returns and your win rate. So those are your two things that you need to be concerned about in regards to trading an edge over time. So stop being concerned about the trade to trade basis. Stop being concerned about how your last trade is going to be affecting your next trade, because all of that is irrelevant. You want to be focused on your result over a number of occurrences. So that's why I think it makes absolutely no sense to think about, oh, I'm scared to put on a trade, or I'm scared about the result of this trade. If your trade falls into the category of the edge that you've identified in the market, then there should be no reason for you to be scared about executing a trade. All you need to do is identify the edge and then execute the edge a number of times to measure the edge, essentially, right? And the beauty with trading smaller sample sizes is that if you see that your edge is starting to fade, you will know relatively quickly because your sample size is small enough, right? So if all of a sudden I have 15 losers and 5 winners in a sample size of 20, I'm gonna see what happened and I'm gonna say, okay, either this edge is not working anymore or I'm making some very critical mistakes here, okay? That will stop you from going too far down a losing streak because you'll see that your edge is clearly not performing as well. I want to talk about one other thing to continue here, which is understanding a baseline probability in the market using the performance profile for options. All right. So when you take a contract, could be any contract, you bring it into your window in the TWS platform, you will be able to pull up what is called a performance profile. This is what the performance profile window looks like in TWS. Now the market's closed, so you can't see anything. This performance profile window is the equivalent of a baseline probability that the options market is implying for this contract, which means that based on the options implied volatility currently and the options Greeks, this is the probability that this option will expire in the money or out of the money, and it works for strategies as well as individual contracts. All right. The reason why a baseline probability is important is because it gives you a perspective to work off of to start, right? So it can tell you that this 296 call has an approximate probability of being profitable of about 30%. Based on how close it is to being in the money, right? It doesn't necessarily mean that if you buy it and sell it that you have a 30% chance of making money, because that's not true. If you buy a call on a dip, you can easily sell it for a profit on a rip. So this profit probability here is only in relationship to how out of the money or in the money the contract is and how likely it is to expire worthless. But the beauty of this performance profile is that it will give you a baseline probability. Down here, it will also show you scenarios of the underlying and what it will do to the profit or loss of this position. So you can see that if the underlying stays there, that's where your profit or loss will be. If the underlying moves down by 3%, that's where your profit or loss will be. If it moves up by 3%, that's where your profit or loss will be. So this tool right here, I might make a separate video on it entirely, is very useful for identifying a baseline probability. Baseline probabilities are so important because they give you a perspective of what the market thinks is most likely. Then it's up to you to be able to identify if you think that that baseline probability is being overestimated or underestimated. And that's how you can construct a high probability trading scenario. All right, guys, so that's going to be the end of this video for today. We're going to continue making videos relating to trading and psychology and probabilities. So if you enjoy the content, please leave a thumbs up. I'll see you in the next video. Take care. Bye.